Picture yourself, just for a moment, standing on the sidewalk in front of an open house.
Oh, okay. I can see it.
Right, so if you have ever waded into the real estate market,
Hmm?
you already know that the entire experience, it completely changes depending on the broader economic weather.
Oh, absolutely. It is night and day.
Yeah, because sometimes you walk into a true buyer's market, there are houses sitting empty on every block, and sellers are practically, pulling you inside.
They're slashing asking prices.
Exactly. They'll happily fix that leaky roof before you move in,
Yeah.
and it is just effortless.
Yeah.
But try looking for a house in that exact same neighborhood a few years later, and suddenly you are in a seller's market. Inventory is a ghost town. Prices are astronomical. And if you don't show up with a briefcase full of cash,
And waive every single inspection.
right, your offer goes straight into the shredder.
And the underlying asset, I mean, the actual house itself hasn't changed at all, but the paradigm surrounding it has completely flipped, which makes the whole process of acquiring it feel entirely different.
Which brings us to the core of today's deep dive. We are pulling directly from the Insurance Study Companion to unpack a fundamental force in the insurance industry that operates, well, almost identically to those wild swings in real estate.
It really does.
It's this concept that explains why an insurance policy can be incredibly cheap and easy to get one year and then nearly impossible to afford the next, even if you haven't changed a single thing about your life or your business.
Right. Industry insiders refer to this as the underwriting cycle.
Okay, the underwriting cycle.
Yeah, it is the continuous macroeconomic switching back and forth between what we call a soft insurance market and a hard insurance market.
Got it.
And honestly, understanding the mechanics of this cycle is kind of the skeleton key to understanding the entire industry.
And that makes this crucial for a very specific slice of our audience. Because if you are currently buried in textbooks preparing for a CPCU exam, maybe CPCU 500, 520, or 557, or if you are an insurance professional looking to understand the forces dictating your daily underwriting decisions, this deep dive is built to map that out for you.
Exactly.
But even if you are just a business owner trying to figure out why your commercial premium suddenly doubled, we are going to look under the hood today and show you the exact financial engine driving those prices.
Yeah, and we should probably establish the baselines first. Let's look at the two extremes of this cycle.
Makes sense.
We can start with the phase that consumers and brokers generally prefer, which is the soft market. This is the buyer's market from your real estate analogy.
Okay, so the sources outline a few defining traits here. In a soft market, premiums are low, insurance is cheap.
Right.
But it's also categorized by something called loose underwriting, which essentially means the insurance companies are not putting risks under a microscope.
No, they really aren't. They are willing to write policies for a much wider variety of people and businesses.
So a good memory trick from the text is that soft equals easy plus cheap.
That is a great way to remember it. Soft is easy and cheap, and exactly why they do this comes down to market capacity.
Capacity meaning money.
Yeah, basically. During a soft market, there's a massive amount of capital flowing through the industry, and there are plenty of insurers fighting tooth and nail for your premium dollars.
So it's super competitive.
Intensely competitive. That competition is the defining engine of a soft market. Insurers have strong financial backing, so their primary goal shifts toward capturing market share.
They just want bodies in the door.
Exactly. They want to bring in as many policyholders as possible, and the absolute easiest way to do that is to lower prices and relax their acceptance standards.
But the sources use a really specific visual to explain why the market never stays in that comfortable cheap phase. They compare the underwriting cycle to a swing on a playground.
I love that analogy.
Right. So when you have all these insurers aggressively lowering their prices to win customers, they're essentially pushing the swing higher and higher into the soft market.
Yeah, building up all that momentum.
But if we follow the physics of a swing, it eventually hits a peak and has to rush backward.
It has to.
So wait, are you saying that by making things incredibly cheap and easy for the consumer, insurers are inadvertently sabotaging their own future stability?
What's fascinating here is that, yes, they absolutely are. They are actively eroding their own financial foundation.
Wow.
Because when insurers charge artificially low premiums to win business, they are still legally obligated to pay for the risks they just took on.
Right. The claims don't care that you got a discount.
Exactly. The premiums are coming in at a discount, but the claims, car accidents, house fires, liability lawsuits, those real-world costs keep happening at their normal expensive rate.
So the math just flips upside down. The claims coming in are suddenly costing more than the discounted premiums they collected.
which causes their profit margins to compress, and eventually they just vanish.
Ouch.
Yeah, and when an insurance company stops making an underwriting profit, their available capital drops.
And capital is just the financial surplus they keep in the bank, right? Like
Yeah.
to back up the promises they made to their policyholders.
Exactly. And as that surplus drains away, the insurers wake up and realize they are dangerously overexposed. They just don't have the money to keep playing the high volume, low margin game anymore.
And that is the momentum shifting the swing backward. They have no choice but to slam on the brakes.
They absolutely must protect whatever surplus they have left, and to do that, they drastically tighten their underwriting guidelines.
The memory trick for this one is hard equals strict plus expensive.
Yes. They stop accepting marginal risks entirely. They aggressively raise premiums on the customers they do keep. And this highly restrictive environment, that is the hard market.
The seller's market.
Yeah.
Capacity shrinks, competitors drop out, and it becomes incredibly difficult and expensive to buy a policy.
It really does.
But the swing doesn't stop there either, because once they spend a few years in this hard market, charging premium prices and strictly avoiding bad risks, they start making money again.
Oh yeah, their capital reserves rebuild. And, you know, high profit margins never stay a secret for long.
Right, Wall Street notices. Other investors and new insurance companies see those juicy profits happening in the hard market, and they want a piece of the action.
Of course they do. So they enter the arena, bringing fresh capital with them.
And now we have new competitors trying to steal business away from the established players, and how do they do it?
By dropping prices.
And boom, the swing pushes right back into a soft market.
Exactly. It is a continuous, self-correcting loop driven entirely by the tension between available capital and the hunger for market share.
Okay, so that theoretical loop makes perfect sense. A slow, invisible erosion of profits leading to a slow tightening of the market. But the study guide makes it clear that this isn't always a slow process, right?
Oh, definitely not.
Yeah, sometimes the swing from soft to hard happens violently, like overnight. I really want to look at the physical, real-world events that trigger a rapid market collapse.
Well, the most visceral example provided in the Insurance Study Companion involves commercial property insurance facing a major catastrophic weather event.
Okay, let's lay out the scenario for the listener. Say you own a manufacturing business on the Gulf Coast.
Right. Prime hurricane territory.
Exactly. The market has been soft for half a decade. Insurers have been fighting for your business, so your commercial property premiums are wonderfully low. You're happy.
Very happy.
But then, hurricane season arrives, and it is unprecedented. 3 major Category 4 storms hit the coastline in a single month.
Which is devastating. The physical destruction is catastrophic, obviously, but the financial destruction within the insurance industry is just as severe.
Because they have to pay for all of it.
Right. Those insurers who were happily collecting low soft market premiums are suddenly hit with billions of dollars in claims all at once.
The money flowing out is literally a tidal wave compared to the little bits of premium they took in.
It is.
And exactly how much this damages them comes down to a regulatory concept the sources mention called risk-based capital, or RBC.
RBC, yes. This is a huge.
Yeah, because this isn't just about an insurance executive being upset about a bad quarter. This is about government regulators stepping in.
Regulators monitor insurance companies very, very closely to ensure they remain solvent.
They want to make sure the companies don't go bankrupt.
Exactly. The RBC ratio is a metric that compares an insurer's available capital to the massive amount of risk they have taken on.
Okay.
If a series of hurricanes wipes out $1 billion of an insurer's surplus, their RBC ratio plummets.
Oh, wow.
Yeah, and they cross a dangerous regulatory threshold where the government might actually force them to stop rating new business or even take over their operations entirely just to protect the consumers.
So to avoid being shut down by the government, the insurer has to immediately alter their risk profile. They initiate a rapid, aggressive hard market.
They have to. They raise premiums across the board to inject cash back into their reserves.
But they also attack the risk side of the equation, right?
Yes, they reduce coverage limits, meaning the maximum amount they will pay out for a building is capped at a much lower number.
Making it less risky for them.
Exactly. And they force policyholders to take on higher deductibles. That shifts the initial financial burden of the next storm back onto the business owner.
Or, if the property's sitting right on the beach, the insurer might just send a notice of non-renewal and walk away entirely.
Yep. The text notes that declining high-risk properties is a classic hallmark of a hard market reaction.
And here is where it gets really interesting. because this dynamic is responsible for one of the most maddening experiences a consumer can have.
Oh, I know where you're going with this.
Right. Let's say your business is located 50 miles inland from those hurricanes. The storms never touched you. You've paid your premiums on time for 10 years and never filed a single claim. You are literally a flawless customer.
The perfect risk.
But your renewal arrives in the mail, and your premium has jumped 80%.
It feels like an arbitrary punishment.
It really does. But when you view it through the lens of the underwriting cycle, you realize you aren't being penalized for your own personal risk.
No, not at all.
The entire pool of capital that your insurance company relies on was drained by the coastal hurricanes. They have to rebuild their surplus to satisfy regulators and stay alive, and the only way to do that is to extract more money from everyone left in the pool.
Right, your rates skyrocketed because the overall market hardened, not because your business became more dangerous.
Which is incredibly frustrating.
It is. But if we connect this to the bigger picture, it fundamentally alters how a professional has to approach risk management.
How so?
Well, if you are running a business or advising one, you cannot afford to view insurance as a passive purchase that you just auto-renew every year. The cycle demands active management.
Okay, so when the market swings hard and those astronomical renewals start rolling in, what does active management actually look like on the ground?
It requires strategic compromises. The sources highlight several tactical responses here. A business might intentionally increase their own deductibles, like agreeing to pay the first $50,000 of a claim out of pocket just to bring the premium down to a survivable level.
So taking on more risk themselves.
Right. Or they might lower their overall coverage limits and just rely on tighter safety protocols at their facilities to prevent a total loss in the first place.
Or the sources say they start looking into alternative risk financing.
Yes, exactly. This is when businesses bypass the traditional insurance market entirely.
Like self-insuring.
Yeah, they might self-insure a predictable portion of their risk or pool their money with other businesses in a similar industry to form a captive insurance company.
So a hard market really forces businesses to get incredibly creative about how they finance their survival.
It does. It's adapt or fail.
And while those businesses are taking on higher deductibles and suffering through high premiums, that very suffering is what heals the insurance market.
That's the irony of it.
Right, those expensive premiums slowly rebuild the insurer's capital surplus. The profits return, new capital enters the arena to chase those profits, competition resumes, and the swing pushes back into a soft market.
Exactly.
Okay, so we've explored the theoretical swing and the catastrophic physical triggers. But the Insurance Study Companion really emphasizes that to master this topic, especially if you are sitting for the CPCU 520 or 557 exams, you have to understand the internal financial instruments insurers use to measure this cycle.
You really do.
External events like hurricanes drain the capital, sure, but we need to look at how executives and underwriters actually track that drainage on paper.
Right. So the sources outline a cluster of interrelated financial metrics that act as the dashboard for the industry. And the most prominent of these is the combined ratio.
The combined ratio. So this is essentially the ultimate scorecard for underwriting profitability.
Yes.
But rather than just defining it broadly as money in versus money out, let's look at how the math actually dictates a market shift.
Okay, so the metric is expressed as a percentage, and the critical threshold to remember is 100%.
100% got it.
The ratio combines two things: the money an insurer pays out in claims, plus the money they spend on operating expenses like, salaries and marketing.
Okay.
It then divides that total outflow by the premium revenue they took in.
So if an insurer collects $100 in premium and they pay out $70 in claims and $25 in operating expenses, their total outflow is $95.
Exactly, giving them a combined ratio of 95%.
Okay.
Any number under 100 indicates an underwriting profit. In that scenario, they are keeping 5 cents of every dollar.
Which is good.
Very good. When capital is growing like that, they can afford to remain in a competitive, soft market posture.
But if a series of brutal winter storms hit, and they end up paying out, let's say, $85 in claims alongside that $25 in expenses, their outflow is now $110.
Right, and the combined ratio hits 110%. They are literally losing 10 cents on every single dollar of premium they write. And that is the mathematical trigger. When a company's combined ratio consistently stays above 100, their capital surplus is bleeding out.
So they have to react.
They are mathematically forced to initiate a hard market strategy. They start raising rates and tightening guidelines just to drag that ratio back below 100.
But measuring that ratio relies entirely on knowing exactly how much you are paying out in claims,
Yes.
which brings up a really fascinating complication mentioned in the text: loss reserves.
Ooh, loss reserves are tricky.
Because if a hurricane tears the roof off a building, the cost is relatively easy to calculate and pay out quickly.
Right. Physical damage is straightforward.
But what about a commercial liability policy? Say someone slips and falls in a grocery store, suffers a severe spinal injury, and sues the store. That lawsuit might drag through the court system for 4 or 5 years before a settlement is even reached.
Exactly. The insurer won't know the final actual cost of that claim for half a decade.
But they can't just ignore it.
Right. No, regulatory accounting requires them to set aside money for that claim at the very moment the accident happens.
Okay.
And that pool of set-aside money is what we call a loss reserve.
So the underwriters have to estimate the future cost of a claim today. And if they estimate poorly, the entire foundation of the cycle kind of shakes.
It really does. Reserve inadequacy is the silent killer in the insurance industry.
Silent killer. How so?
Well, let's say actuaries estimate that a batch of complex liability lawsuits will cost $10 million, and they set that money aside in reserve. On paper, their combined ratio looks healthy. They think they are profitable.
Okay.
But 3 years later, massive jury verdicts come down, and those claims actually end up costing $15 million.
Oh, man. So the insurer is suddenly short $5 million.
Right. And that money has to come directly out of their current capital surplus today.
So it's like a ghost from the past haunting their current budget.
That's a great way to put it. Reserve inadequacy creates this delayed shockwave. When insurers are forced to continually strengthen their reserves to pay for past mistakes, their current profitability tanks, which totally accelerates the push into a strict hard market.
So if an insurer's combined ratio spikes over 100 and their loss reserves are woefully inadequate, they are hemorrhaging capital. Who bails them out?
Well, the sources point to the next critical mechanism: reinsurance.
Reinsurance?
Yeah, reinsurance is simply insurance for insurance companies.
Okay, that makes sense.
A regional insurer operating entirely in Florida cannot possibly hold enough capital to survive a direct hit from a Category 5 hurricane all by themselves.
Right, they'd be wiped out.
Exactly. So they pass a portion of their risk and a portion of the premium up the chain to massive global reinsurance companies based in places like Zurich or Bermuda.
This connects the local business owner's premium directly to global capital markets.
Yes, exactly.
Because if global reinsurers take a massive financial beating, maybe because of, I don't know, a typhoon in Japan, massive floods in Europe, and a hurricane in Florida, all happening in the exact same year, their global capital drains.
And when that happens, the reinsurers then harden their own market. They charge the local Florida insurance company significantly more for that vital safety net.
And the local insurer, they don't just swallow that extra cost out of the goodness of their hearts.
Oh, definitely not. They pass it directly down the chain to the consumer.
The study guide makes it explicitly clear here. Expensive reinsurance leads directly to higher direct premiums. The local market hardens because the global market hardened.
Right. And this interconnectedness really brings us to the traps that frequently catch students off guard on the CPCU exams.
Let's talk about the exams.
Yeah, specifically regarding what actually causes premiums to fluctuate.
Let's unpack the two major traps highlighted in the text. Trap number one is a failure of perspective.
How so?
Well, people look at the general trajectory of the economy. They see inflation making groceries and cars more expensive every single year, and they assume insurance premiums operate on the exact same principle, just a steady, permanent upward slope.
It is entirely logical to assume that, honestly, but it is fundamentally incorrect. Insurance pricing is cyclical. It's not strictly inflationary.
Right.
A business might pay $20,000 for a policy in 2020, see it spike to $40,000 during a hard market in 2023, and then watch it fall back down to $25,000 in 2026 as new capacity enters the market.
So assuming prices only go up ignores the entire recovery phase of the underwriting swing.
Exactly. It completely misses the soft market phase.
Trap number two is a bit more insidious, though, because it deals with cause and effect. The trap is believing that claim frequency alone causes the market to shift.
Yes, this is a huge misconception.
But if I am studying for this exam, my instinct says that if a massive wave of claims comes in, the insurer is losing money, so they have to raise prices. It feels like a direct one-to-one relationship. So why is it a trap to blame the cycle entirely on claim frequency?
Because that assumption completely ignores the other half of an insurance company's operation.
The other half.
Yes, insurers do not just take your premium and lock it in a vault until a claim occurs. They invest that money. Investment returns are the hidden engine of the underwriting cycle.
Oh, wow. So they act almost like massive hedge funds that happen to sell insurance policies to generate their initial capital.
That is a very apt way to look at it. The time delay between collecting a premium in January and potentially paying out a claim in December gives the insurer 12 months to generate returns in the stock and bond markets.
Okay.
This raises an important question, though, because it creates a scenario where strong investment income can completely mask terrible underwriting results.
Wait, really? Mask it how?
Well, imagine a situation where claim frequency is incredibly high. The insurer's combined ratio is sitting at 105%. They are losing 5 cents on every premium dollar they write.
Okay, so by all the metrics we discussed earlier, they should be panicking, tightening underwriting, and initiating a hard market immediately.
But what if interest rates are at record highs and the stock market is experiencing an unprecedented bull run?
Right.
What if the insurer's investment portfolio is generating a 10% return on all that premium cash they are holding?
Oh, I see. The math saves them. They lose 5% on the insurance side, but they make 10% on Wall Street. They are still netting a solid profit overall.
Exactly. Which means they don't actually have to raise premiums. They can afford to keep their prices artificially low, maintaining their competitive edge and staying in a soft market posture, despite the fact that their claims experience is objectively terrible.
That completely flips the script. The investment income is actively subsidizing the cheap insurance.
It is.
But that also reveals how fragile a soft market can be, doesn't it?
Oh, very fragile.
Because if an insurer is relying on a booming stock market to cover their underwriting losses, what happens when the broader economy enters a recession?
Exactly. The stock market tanks, their investment returns evaporate, and suddenly that 105% combined ratio isn't being masked anymore.
It is just bleeding capital.
Yep. That specific combination deteriorating investment returns colliding with high claim frequency, that is the recipe for the most severe, rapid transitions into a hard market. Executives realize they have no financial cushion left, and the tightening is immediate and brutal.
It proves exactly why the CPCU exams test this so rigorously. Claim frequency alone does not dictate the cycle.
No, it's a mix.
It is this complex, fragile mixture of underwriting losses, loss reserve adequacy, reinsurance costs, and investment income that really determines where the pendulum swings.
Exactly. It's an entire ecosystem.
We have pulled apart a massive amount of technical machinery today. But if we distill all these metrics, catastrophes, and capital flows down to a practical takeaway, what is the core lesson a listener should walk away with?
I'd say that the underwriting cycle is essentially the gravitational force of the insurance industry.
The gravitational force. I like that.
Yeah, because every single decision made from a local agent quoting a policy to a global reinsurer allocating capital is influenced by where the market currently sits on that swing.
Right.
If you are a student, remember the distinguishing characteristics. Soft markets are defined by abundant rapacity, intense competition, and relaxed standards. Easy and cheap.
Easy and cheap.
Hard markets are defined by capital depletion, retreating insurers, and restrictive pricing. Strict and expensive.
Strict and expensive.
And crucially, remember that profitability, or the lack thereof, is the mechanism that forces the transition between the two.
It really is a brilliant self-regulating system. A soft market eventually starves itself of capital, creating a hard market. And the hard market eventually generates massive profits, attracting new capital, which creates a soft market.
The swing just keeps moving.
But as we wrap up this deep dive, I want to leave you with a final thought to chew on. Something that challenges the historical precedent of the sources we just reviewed.
Okay, I'm intrigued.
The entire theory of the underwriting cycle relies on the idea that the hard market always recovers, right? It assumes that once premiums get high enough, new insurance companies will inevitably rush back in to chase those profits, restoring capacity.
That's the historical precedent, yes.
But what happens if the nature of risk itself fundamentally changes? What happens if climate-driven catastrophes, massive coastal flooding, year-round wildfires, unprecedented hailstorms become so frequent and so financially devastating that they basically defy actuarial modeling?
Wow. Well, it creates a scenario where the risk becomes truly uninsurable at any price point.
Exactly. If the sheer unpredictability of a region guarantees a massive loss, then it doesn't matter how high the hard market pushes the premiums. New investors and new insurance companies simply will not enter the market. because there is no reliable path to profitability.
So the swing just stops.
Right. Could the pendulum of the underwriting cycle ever swing into a hard market and permanently snap? Could we see regions where the capacity never returns, leaving businesses and homeowners with no private safety net at all?
That is a fascinating and honestly slightly terrifying evolution of the concepts we've discussed today.
It is definitely something to think about. Thank you for joining us on this deep dive. Whether you are walking into a CPCU testing center this week or just trying to navigate the renewal of your own commercial policies, keep the mechanics of this cycle in mind. The next time you see a market shifting, look past the price tag, look at the capital flowing underneath, and try to figure out where the swing is heading next.